So 186 banks, supposedly, if they had to start liquidating assets to meet withdrawal requests, they would fail. Hey, it's Kevin Amolsch, Pine Financial Group, where we work together so you succeed. Hey, you found us here on Facebook. You found us here on YouTube. Please do me a favor and hit like, hit subscribe. We're trying to build a channel to help more real estate investors just like you. Today is no exception. I'm going to be talking about what I think may be a banking crisis. I've mentioned this on several of our town halls and our webinars, some of the other things that we do in the office for our clients and investors. But I really think that the banking system in the United States is in a bit of trouble. And I just read an article today that really illustrated this pretty well. So I wanted to get on here quick, shoot the video, get the information out there so that you could at least be prepared for what may be coming. So USA Today reported that a recent study suggests that 186 banks are at risk of failure. Now, we had a couple of banks fail earlier in the year, correct? Like 3 of them in March and April. And the government, luckily for depositors, came in and bailed out the depositors. So even the uninsured depositors got all of their money back. There was no losses to individual depositors or business depositors. So it wasn't as big of an issue as it could normally be. See, normally if you have deposits above $250,000, it's not insured by the FDIC, meaning if there's a bank failure and a liquidation, there's a pretty high chance of you taking a loss to your deposit. So it sounds crazy, but money in the bank isn't always as safe as we think, especially if you're over that $250,000 insured deposit amount. So here's where the risk comes in, according to this study. They claim that 186 banks are at risk of failure if at least half of the uninsured deposits want their money back. They want to withdraw their money from the account. So if you get half of the uninsured deposits withdraw their money, 186 banks have a pretty high likelihood of failing, according to the study. So what does that mean? Like, if you think about it, if there's a problem in banking and people are going to take a run at the bank, they're going to start pulling their money out. Who's going to be the ones that take the money out of the bank? Well, it's the uninsured money that's going to come out of the bank first, right? So that's why the study really focused on those deposits and if the bank can handle a run like that. So 186 banks, supposedly, if they had to start liquidating assets to meet withdrawal requests, they would fail. So you think about what assets a bank has that they could liquidate to generate cash to return deposits. Oftentimes, you guys, it's long-term loans. So it's like commercial loans and treasuries, like 10-year treasuries. And the problem comes in when you have mark-to-market. So mark-to-market means that they have to mark the asset down to the market value, not what it's sitting on the balance sheet at. That's not the real value, you guys. What the real value is what you could sell it for. So they mark down these assets and it shrinks the balance sheet. In these cases, what the study is saying here is if you have to liquidate a treasury at, let's say you have a treasury, 10-year treasury at a 1% rate, and I know I can go out and get a treasury right now at 4. Why would I want your 1% treasury? The only way to sell that treasury is to bring the price way down to make the return similar or the same as what I can get a brand new treasury for. So that's why the values of these long-term assets decrease so much. So I've been saying that there's a banking crisis for a while. I think a lot of it has to do with the long-term low interest rate assets and then the commercial loans. So this is interesting that the study is agreeing with everything I've been trying to say. And I want to mention that there's a couple of things that could change the opinion here. So if we see interest rates come down, then obviously crisis could be averted. There'll be no banking crisis, right? Because then they would be able to liquidate the assets at a higher price than they could with high interest rates as they are right now. But what happens if rates continue to go up? You know, we've had treasuries hit highs since before 2008 crisis. So the last high that we're seeing right now was in 2007. So this is very high interest rate environment. And it's been going up. So if it continues to go up, what could happen? It could actually accelerate the crisis that we're talking about. We might see more banks start to topple or collapse here. And I want to mention one other thing, the damage is already being done. So if you're a bank that's at risk, if you're one of these 186 banks, you need to hoard cash in case depositors do want their money back. You can't go out and invest it in treasuries and in loans. So they're not originating very many loans. Credit has tightened significantly. They are turning down, even if they're high quality loans, banks are turning these down. So what is that doing? It's crushing commercial real estate, not to mention the commercial real estate that's going to be coming due pretty soon. So I want to share my screen here and show you a little graph. Okay, so you can see here in my little graph, loan maturities by asset classes. So I've been saying for a long time that the loan maturities is the biggest concern for commercial real estate. And the reason I say that is a lot of these loans that you're seeing here that will be maturing in the next 1 to 2 years have pretty low interest rates, and they qualify for the bank financing at those low interest rates, meaning the property produces enough income to pay the debt. But what happens when the interest rate doubles or triples and the debt hasn't been reduced on the property enough? Then when you go to refinance it or modify the loan or extend the loan, it no longer qualifies. You see, banks' requirements have a debt service coverage ratio. The property has to produce enough income to pay the debt, or it's not going to be approved for the loan. And you could see here about 700, maybe 720 or so $billion in loan maturities yet in 2023, and pretty close to that again in 2024. That is a ton of commercial real estate loans coming due. That's going to put added pressure on these banks, especially with the declining values in commercial real estate. And you could see here that multifamily and office have the biggest risks. So I would definitely expect to see some further softening in multifamily and office, which means cap rates go up, values of the properties go down. So I absolutely expect that. So you combine the high uninsured deposit risk with the commercial real estate risk, and I think we might see some type of bank collapse. I don't necessarily want to see that, but the good news for us real estate investors, if we start seeing banks go down, it's going to create more and more opportunities for us to go and get great deals. So on the bright side, let's just stay focused on buying high quality deals. When you underwrite it, stay very firm in your opinions of values. Don't fudge it. You don't need to do a deal right now. We do believe that there's going to be some more opportunities coming as you start seeing banks collapse or merge or get acquired. So hopefully you find this information helpful. I know it's not roses and rainbows like sometimes we talk about here. This is just real life, guys. There is definitely some turmoil out there. So let me know what you think. Do you agree with me? Do you not agree with me? Do you think the study is full of crap and none of this is even true? Let me know. Leave me some comments below and be sure to hit like and subscribe. And check us out at pinefinancialgroup.com.